Hello, everyone. Let's start our today's discussion. I hope you all remember that in previous classes, we were discussing basic income tax calculation of individuals. Let's take a quick review of what we have discussed in the previous classes, and then we'll start our today's discussion. We started this chapter with the format of basic income tax return of individuals. In UK tax, income earned by individuals is divided in three heads: non saving income, and dividend income. Because each of the head of income has its own separate tax rates defined by the tax department. Non saving income include all incomes except interest income, which is classified as saving income, and dividend income, which is classified in its own head. Okay? Once we classify the income three heads, we arrive at the value of total income. Then we adjust the personal allowance to arrive at the value of taxable income. Then we introduce the tax rates of non-saving income. In basic rate band, which is from 1 to 37,700, the tax rate is 20%. From 37,700 to 150,000, it is higher rate band and the tax rate is 40%. Above 150,000, it's additional rate band and the tax rate is 45%. So once done with the basic format of income tax return, personal allowance, and the tax rates of non-saving income, we did two practice questions in this regard. By now, you all know my approach that we discuss a concept and then we do practice questions so that the procedure and the calculation aspect gets clear. Then we introduce the concept of real estate investment trust. It is a mutual fund which raises investment from the public and then invests those funds in real estate, the property market. It earns from rental incomes and capital gains. When a REIT earns and it distributes the dividend among its investors, it is treated as a non-saving income and withholding tax. The advanced tax is 20%. We discussed this concept of REIT and then again we did two practice questions in relation to it. So approach is to discuss the concept, introduce new topics, and then do practice questions so that concepts get clear. Then we introduce the concept of dividend income, the profit distribution received from the company. Dividend income has its own head. We discussed its tax rates, 8.75%, 33.75%, and 39.35%. Then we did practice questions in relation to dividend. Then we introduced the concept of trust income. Trust is an incorporated body in which the donor gives the assets. Those assets are managed by the trustees for the benefit of beneficiaries. We discussed that why trusts are created and its types: discretionary trust and interest in possession trust. Once done with the concept of trust, again we did practice questions relating to it so that the calculation aspect gets clear. Then we introduced the concept of interest income, which was our previous class. The interest income is classified as a separate head, saving income, and it has its own tax rates. We discussed the 0% band, the withholding tax concept, that normally on interest income, there is no withholding tax. But if it is interest income from unlisted company, then withholding tax of 20% will apply. We discussed national saving certificates and individual saving accounts. And then we did few practice questions. Today, we'll be discussing two concepts. One is qualifying loan interest expense and other one is planning of personal allowance. I want you all to concentrate on it so that you can understand in a better manner. Now, qualifying loan interest expense, what is it? See, if an individual, listen to me carefully, this is the new concept for today. If an individual takes a loan for a qualifying purpose. Listen to me carefully. If an individual takes a loan for a qualifying purpose, then interest expense on that loan is deductible from total income. I'll repeat it again. If an individual takes a loan for a qualifying purpose, then interest expense on that loan is deductible from total income. Now, what is this qualifying purpose? How do we deduct from total income? Let's look at it. If an individual takes a loan for a qualifying purpose, what is qualifying purpose? We'll discuss it. Then interest expense on that loan will be deductible from total income. When we deduct from total income, we get easy rule because total income number is big. We can adjust it from non-saving. If there is no non-saving income, we can adjust from saving. If there is no saving income, then we can go against the dividend income also. So if the loan is for qualifying purpose, the interest expense is deductible from total income. Now, what are these qualifying purposes? Loan taken to purchase plant and machinery for your sole trader or a partnership business. If you own an unincorporated business, unincorporated, which is sole trader or partnership, one is incorporated, the company. I'm not talking about company. I'm talking about sole trader or partnership, which is an unincorporated business. If we take a loan to purchase plant and machinery for our sole trader or partnership business, that loan is a qualifying loan. Interest expense of that loan is deductible from our total income. Loan taken to purchase plant and machinery for your employment. Sometimes in job requirement, there is written that you need to have a laptop or some other machinery. So if I take a loan to purchase plant and machinery for my job, so that is also a qualifying loan. Loan taken to invest in a closed company. Now, what is closed company? We'll discuss the concept of closed company in very much detail when we'll be studying corporation tax in later part of the course. But for now, closed company is a company which is a family-owned business, a family-owned company. So if we take a loan to invest in a closed company, that is also qualifying loan. Loan taken to pay inheritance tax. In UK, there is a concept of inheritance tax that if you receive a gift, you have to pay inheritance tax on it. So if you have to pay any inheritance tax and we take a loan for that, that is also qualifying loan. And loan taken to invest in cooperatives. Basically, cooperatives are the organizations which work for the benefit of their members. Listen to me carefully. If we take a loan for a qualifying purpose, listen to me. If an individual takes a loan for a qualifying purpose, then interest expense on that loan will be deductible from total income. Listen to me carefully. If an individual takes a loan for a qualifying purpose, then interest expense on that loan, not the loan amount, I'm talking about interest expense. Don't deduct the loan amount. I'm talking about interest expense. The interest expense is deductible from total income. Now, what are the qualifying purpose? Loan taken to purchase plant and machinery for sole trader or partnership business, for employment purpose, to invest in closed company, to pay inheritance tax, to invest in cooperative society, which work for the benefit of members. If you take loan for these purposes, it's a qualifying loan. The interest expense is deductible from total income. Okay, let's look at a practice question so that you can have a clarity. Okay, when we'll do the practice question, the things will get clear. I want you all to concentrate on it. Mr. G has following data for the year. Employment income 18,000. Interest income from war loans 22,000. It's a normal interest income. Okay? If it's a war loan, whatever, it's a normal interest. Interest income from national savings certificates. This is exempt interest. National savings certificate and individual saving account is exempt. Dividend income 12,000. Interest expense paid on loan to acquire plant for employment 29,000. Let's look at it. I want you all to concentrate. First column is total, then non-saving, saving, and the last one will be dividend. I want you all to concentrate on it. Now, employment income. What is the amount of employment income? 18,000. I'll update in total and in the column of non-saving. Okay? Now, then we have interest income. We have interest income. The interest income amount is 22,000. I will update in total and it will go in the column of savings. Okay? War loans or whatever, it do not create any difference. National saving certificates. It is exempt. National saving certificate. It is an exempt source of income. So we'll not show it anywhere. And then we have dividend income. I will put it in total and in the column of dividend. Okay? We will add up all of them to arrive at the value of total income. 18 plus 22 plus 12. So it's 52,000 in the column of total. Here 18, here it's 22, and the last one is 12,000. I want you all to concentrate on it while I repeat the things again. Just a second. The pencil is misbehaving. Yeah. Okay. Now listen to me carefully. Employment income 18,000 goes in non-saving. Interest income from war loans. Okay. War loans are those loans which are taken by the government in times of war, but it's normal interest income. It is not exempt. It goes in the column of saving. National saving certificate is exempt, and dividend goes in the column of dividend. Now we have this interest expense paid on loan to acquire plant for employment. So this is called qualifying loan interest. Qualifying loan interest, 2,900. We will adjust it in the total and in the column of non-saving. See, the total column is basically the sum. In the head of income, we are adjusting it in non-saving. Now we will arrive at net income. Okay. And then we will adjust the personal allowance to arrive at the value of taxable income. Okay. I will repeat it again. I want you all to concentrate on it. See, qualifying loan interest expense. It is adjusted from total income. So 52,000 minus 2,900. So it's 49,100. Now the non-saving stands at 15,100. Saving is same 22,000 and dividend is 12,000. Now we'll adjust the personal allowance. 12570. The priority is non-saving. 49,100 minus 12570. So it's 36,530. And now the non-saving column reflects how much? 2,530. This is 22,000. and this one is 12,000. Okay. Now, we are a basic rate taxpayer at total taxable income level. Basic rate taxpayer. Just a second. Basic rate taxpayer. Okay. Now, basic rate taxpayer means that 0% band will be of 1,000 pounds. Let's calculate the tax and then I'll repeat it again. Our non-saving income here is 2530. So the basic rate band is still 37,700. So this 2530 goes at 20%. So it's 506. Now in this question, there is one good concept for understanding. Saving income. Saving income is 22,000. Now here you need to listen to me carefully. If the saving income lies in first 5,000 pounds of taxable income, you remember we studied it in the last class? Now, if I look at first 5,000 pounds, non-saving has occupied 2530. So the remaining amount which goes to saving income, 5,000 minus 2530. So it's 2470, which will be taxed at 0%. I will repeat it again. If you people remember, if the saving income lies in first 5,000 pounds, remember, if the saving income lies in first 5,000 of the taxable income, there is a 0% tax. Now, since non-saving is 2530, saving will only get space of 2470. Okay? Now, the normal 0% band of saving income, which will be of 1,000 since the person is a basic rate taxpayer. Okay? And the remaining amount. 22,000 minus 2470 minus 1,000. So it's 18,530. Basic rate for saving income is 20%. 3706. If you have any query, don't worry, I'll repeat it again. Then we have dividend income, that is 12,000. Dividend, 12,000. First 2,000. First 2,000 goes at 0%. So this gives us 0. And remaining 10,000, since we are a basic rate taxpayer, so 8.75%. So it's 875. If I add up all of them, I'll arrive at the value of tax 506, 3706, and 875. So it's 5087. There was no advanced tax in the question, so no issue of tax credit. Let me repeat it again for you people. Listen to me carefully. Employment income goes in non-saving. Interest income goes in saving. National savings certificate exempt. Dividend income goes in dividend. I believe that by now, this all is just routine. We have done it so many times. Add up all of them to arrive at total income. Qualifying loan interest expense. Purchase plant for employment. Loan to purchase plant for employment. It's a qualifying loan interest expense. You adjust it from total income. We arrive at net income. We adjust the personal allowance to get the taxable income. Is it clear? Now let's charge tax on it. 2530 goes in basic rate band. Now, saving income. First 5,000 pounds are taxed at 0% if they lie in first 5,000 pounds of taxable income. Now, if I look at first 5,000 pounds, 2530 is acquired by non-saving, remaining space 2470 goes at 0%. Then saving income 1,000 pounds at 0%, and the remaining saving income 18,530 at 20%. Then we have dividend income 2,000 at 0% and remaining at 8.75%. So the only new thing in this class, just this one line adjustment, qualifying loan interest expense. If you take loan, listen to me. If you take a loan for a qualifying purpose, then interest expense on that loan is adjustable from your total income. I believe that there's nothing difficult in it. The interest expense is deductible from your total income. Is it clear? Let's look at one more practice question. I believe that you people can do it on your own also. So if you want, you can pause the recording and you can try it on your own first. Okay? Now, Mr. G has following data for the year. Trading income 19,000. Interest income from unlisted company 25,000. Now, many students forget here that when there is interest income from unlisted company, there is withholding tax of 20%. Okay? Normally on interest income, there is no withhold. But when it is interest income from an unlisted company, withholding tax of 20% will apply. Interest income from individual saving account, it's exempt. And then we have dividend income 16,000, interest expense paid on loan to invest in cooperatives, it's qualifying loan interest 4,000. Okay, let's start. I want you all to concentrate on. One column will be total, then non-saving, saving, and dividend. Okay, let's look at it carefully so that you can understand in a better manner. Trading income. Trading income is 19,000. I'll put it in column of total and classification will be in head of non-saving. Okay. Then we have interest income from unlisted company. Normally on interest income, there is no withhold, but since it's unlisted company, so we need to gross it up, divided by 80%, multiplied by 100%. So the gross amount will be 31,250. And this goes in the head of saving income. Okay. Then we have individual saving account. Individual saving account is an exempt source. So 0, 0, 0, and 0. No need to show anywhere. And then we have dividend income, that is 16,000. We will put in the column of total and in the column of dividend. Okay, let me repeat it again. I want you all to concentrate on it. See, what we have done is we have simply classified the incomes in all of them. Trading income 19,000 goes in non-saving. Interest income from unlisted company goes in saving because interest income is a saving income. Since it's an unlisted company, so withholding tax is 20%. Individual saving account exempt and dividend goes in the column of dividend, nothing new in it. Then we have interest expense paid on loan to invest in cooperative. It is a qualifying loan interest expense. We will adjust it from total income. Okay. So let's add up all of them. 19,000 plus 31,250 plus 16,000. So it's 66,250. Here it's 19,000. Here it's 31,250. And this is 16,000. This is our total income. Now we'll adjust qualifying loan interest expense. Qualifying loan interest expense, it's 4,000. Loan to invest in cooperatives, we'll adjust in the column of total, and the classification head is non-saving. This gives us net income. The net income is 62,250. Here it will be 15,000, 31250, and this will be 16,000. Then we'll adjust the personal allowance to arrive at the value of taxable income. Okay? So the personal allowance is 12570. We'll adjust it here in the column of total and in non-saving, because non-saving has the highest tax rates. So 62250 minus 12570. So it's 49680. We are a higher rate taxpayer. So saving income 0% band will be of £500. 15,000 minus 12570. So it's 2430. Here it's 31250. And this is 16,000. So some very basic level working, nothing new we have done here. Okay, now let's charge text on. I want you all to concentrate on non-saving. Non-saving is 2430. Obviously, it's in basic rate band because basic rate band is still 37,700. So 2430 into 20%, this gives us 486. Okay, then there is saving income 31250. If it lies in first 5,000 pounds of taxable income, there is a 0% back. So how much amount? 5,000 minus 2430. So it's 2570, which will be taxed at 0%. So it's 0. Okay. Then we are a higher rate taxpayer. So 500 pounds goes at 0%. So it's again 0. And then last, the remaining amount. 31250 minus 2570 minus 500. So it's 28180. 20% is the tax rate. So it's 5636. And then at last we have dividend income. Okay, our dividend income is 16,000. First 2,000 always go at 0%. I believe that this is nothing new. We have done it many times. Now we need to look at the basic rate band, because the band must be exhausting by now. If I look at the basic rate band, 37,700 minus 5,000 minus 500 minus 28180 and 2,000. So 2020 is the remaining space in basic rate band on which the rate of tax is 8.75%. So it's 177. The remaining amount of dividend income, 16,000 minus 2,000 minus 2020. So it's 11980, and rate of tax in higher rate is 33.75. So it's 4043. We will add up all of them to arrive at the value of tax liability. So it's 486, 5636, 177, and 4043. So 10342. We will adjust the tax credit from it, the advanced tax, to arrive at the value of tax payable. Okay, the tax credit amount is We grossed up 25,000 to 31250. That is 6250. So the tax payable amount will be 4092. I'll repeat it again. I want you all to concentrate on it. Some very basic level working, nothing new done in it. Trading income goes in non-saving. Interest income goes in saving. Individual saving account is simply exempt. Individual saving account and national saving certificates are exempt. And dividend goes in the column of dividend. We will add up all of them to arrive at the value of total income. Okay? Now we'll adjust the qualifying loan interest expense from total income to arrive at the value of net income. Personal allowance to get taxable. 2430 at 20%. So it's 486. Saving income in first 5,000. If it lies, the rate is 0%. So 2570 at 0%, this gives us 0. Since we are a higher rate taxpayer, so 500 at 0, and remaining saving income at basic rate band. Dividend income, we find out remaining space in basic rate band and the remaining dividend charge. So if you look at it, we haven't done anything difficult till here. It's just repeat, repeat, repeat. We just added one additional line adjustment, and that is qualifying loan interest expense, which is deductible from total income. Okay, what are the qualifying purposes? Loan to purchase plant and machinery for sole trader or partnership, for employment, to invest in cooperatives, to invest in closed company, to pay inheritance tax. So by now, we are done with the basic tax return format. We did income classification, non-saving, saving, dividend. We discussed the tax rates of non-saving income. We looked at the personal allowance, 12570, real estate investment trust, trust income, discretionary trust, IIP. We discussed interest income, the saving income act, qualifying loan interest expense, and now we have two last things. One is planning of personal allowance, and other one is qualifying donations. So now we'll discuss planning of personal allowance today, and in the next class, we'll complete this chapter with qualifying donations discussion. So by now, you all know my approach. We discuss the concept, we do the practice questions so that the rules get clear in your mind. I hope that you people are understanding it. Now let's talk on planning of personal allowance. Interesting concept, not difficult. Just listen to me carefully. See, we have personal allowance of 12570. You all know that? Listen to me. We have personal allowance of 12570. Okay? Now, how do we utilize this personal allowance? We always adjust it against non-saving income, because non-saving income has highest tax rates. In non-saving income, there are no 0% band. We offset the non-saving to get maximum tax benefit. Personal allowance is first adjusted against non-saving income, as it has highest tax rate and no 0% band. If we don't have non-saving or insufficient non-saving, then we move towards saving income, because it has then the second highest tax rate. And at last against dividend income, because it has lowest tax rates. See, I'll repeat it again. First, we offset non-saving. Always look at these questions. We always hit non-saving first, because non-saving income has highest tax rate. Think logically. We will always offset the income which has highest tax rates, so that we can save maximum. Non-saving income, because it has highest tax rate, then no 0%. Once we offset the non-saving, then we move towards saving income. because saving income has second highest tax rate. Its tax rates are same, 20, 40, 45, but it has 0% balance. And at last, we go for dividend income. So how do we use personal allowance? Non-saving, saving, and then dividend. This is, I think, pretty much simple. And you have done this also. Like if you remember your previous class, these practice questions 16 and 17, we used to offset non-saving. If any allowance was remaining, we go for saving. First, we offset non-saving. Please listen. First, we offset non-saving, and then if any allowance is remaining, we go for saving in. And if still any allowance is remaining, then we go for dividend. The reason for this sequence is tax rates. Non-saving income has highest tax rates, saving income has second highest tax rates, and dividend has lowest rates. We offset the income with highest tax rate to get maximum saving. But now there is one planning situation. If your saving income is already covered at 0% band, listen to me. If your saving income is already covered at 0% band, then don't waste allowance against it. See, if something is already being taxed at 0%, why waste allowance against it? Like, for example, if you have saving income of 1,000, and that will already be covered through 0% band. So don't waste allowance against it, go for dividend income. However, a planning situation may arise. If saving income is already covered at 0% rate, then it will be beneficial to use allowance against dividend. Personal allowance can be used partially against different incomes, like you can use some against saving and some against dividend. But whatever allowance you have to use it in the current year. It cannot be carried forward. I'll repeat it again. And then we'll do the practice questions, obviously, so that it will get clear. Just listen to me, Karan. First, we offset personal allowance against non-saving, because non-saving income has highest tax. We want to save maximum. After non-saving, we go for saving because it has second highest tax rates. And the last hit is on dividend. Are you getting it? Then, if some portion of your saving income is already covered in 0%, then don't waste your allowance against that. Like, for example, here, your non-saving was 2,430. In saving 2,570 and 500 was already covered at 0%. Just take an example. If your saving income would be 3,000 here, so you'll not waste your allowance because that is already covered in 0%. Okay, then it's better to use some amount and then go for dividend. Let's look at the practice question to get clarity. Believe me, it's something interesting. And when you'll be doing the practice question, you will understand in a better manner. Okay, let's read. Mr. K has following incomes for the year. Employment income 6,000, interest from bank loan 7,500, and dividend income is 35,000. Okay, let's start doing it. One column is total, then non-saving, saving, and the last column is dividend. I want you all to concentrate on it. Now, employment income. We will put it in total and in the column of non-saving. Please listen to me carefully. Then we have interest income, interest from bank loan, 7,500. It goes in the column of saving. And then we have dividend income, that is 35,000. Total column, and then in the column of dividend. I believe that there is nothing new. Employment income, non-saving, interest income, saving, and dividend goes in the column of dividend. Okay, We'll add up all of them to arrive at the value of total income. So 6,000 plus 7,500 plus 35,000. It's 48,500. Non-saving, saving, and dividend. Is it clear? We'll adjust the personal allowance. There is no qualifying first expense given in the question. We'll adjust the personal allowance to arrive at the value of taxable income. Now, I want you all to concentrate on it. We'll adjust the personal allowance from the income heads to arrive at the value of taxable income. Okay? Now, first of all, we will adjust the non-saving, then saving, and then dividend. But you need to look at it carefully. Now, if you look at it, my taxable income is 35,930. I've adjusted the personal allowance of 6,000 against non-saving. Now I will adjust it against saving, and if any amount is left, I'll go for dividend. But I want you all to concentrate here. Listen to me carefully. Your non-saving income has fallen to 0. So in saving income, there will be a 0% band of 5,000. In saving income, there will be a 0% band of 5,000. And if you look at your total taxable income, you are a basic rate taxpayer. So you will get one more 0% band of 1,000. So 6,000 of saving income will be taxed at 0%. Use your mind. 5,000 at 0% because non-saving is 0. 1,000 pounds at 0% because you are a basic rate taxpayer. So what I will do is that I will only adjust personal allowance of 1,500 here. The balancing figure. 7,500 is my saving income. 6,000 will be taxed at 0%. So I will only adjust 1,500 of my allowance here. Why? Why? Use your mind. If anything is already at 0%, why to hit personal allowance against it? Okay? What is your remaining personal allowance? 12570 minus 6,000 minus 1,500. Remaining personal allowance of 5070 will be used against dividend income. So my taxable dividend income is 29,930. Look at it carefully. I'm charging tax on it. My non-saving income is 0. So tax on 0 will be 0. We have saving income 6,000. First 5,000 goes at 0% because there was no non-saving income. Saving income will get space in first 5,000. We are a basic rate taxpayer. So 1,000 also goes at 0%. So see, the amount of 6,000 which I left in the taxable head was already covered at 0% band. This is the reason why I didn't waste my allowance against it. Because wasting your allowance against something which is already being taxed at 0%, it's not advisable. It's not a wise decision. Then we have dividend income, 29,930. First 2,000 at 0%. So it's 0. And the remaining dividend, 27,930. The basic rate band of dividend income is 8.75%. So it's 2,444. If I'll add up all of them, my tax amount is 2,444. I'll repeat it again. Listen to me carefully. We first adjust our allowance against non-saving because non-saving income is highest tax base. First hit the non-saving. Then we go for saving income. But when we are offsetting the saving income, what we have to look is that if some amount of saving income is already being covered at 0%, don't use allowance against that amount. Only hit 1,500. Make 6,000 taxable. Because even if it is taxed, the amount will be 0. And then the remaining amount against dividend. I believe that it was not difficult, but still, when you practice the questions, the things will get clear. Okay? So, first non-saving, then saving, but look at the portion which will already be taxed at 0%. And then we go for dividend. Let's look at one more practice question. I want you all to listen to me carefully. Okay? If you want, you can pause the recording and try it on your own also. Let's look at it. Trading income is 7,500. Interest from bank loan is 8,000. Dividend income is 15,000. Okay? So what we'll do is we'll make one column of total, one column of non-saving, then saving, and the last one is dividend. Okay? Trading income. Trading income is 7,500. Goes in the column of non-saving. Interest income. The interest income is 8,000. Goes in the column of saving. Okay? And then the last is dividend income. 15,000 goes in the column of dividend. We have classified the incomes. We'll add up all of them to arrive at the value of total income. 7,500 plus 8,000 plus 15,000. So it's 30,500. Okay? Listen to me carefully so that you can understand in better manner. We'll adjust the personal allowance. 12570 arrive at the value of taxable income. Now, the personal allowance is 12570. So 30,500 minus 12570, it's 17,930. If you look at it carefully, we are a basic rate taxpayer. Okay? First, we'll offset the non-saving. It falls to 0. Then, the next step is saving. But if you look at it carefully, since non-saving has fallen to 0, so 5,000 pounds at 0%, we are a basic rate taxpayer, so 1,000 pounds at 0%. So 6,000 pounds will be taxed at 0%. So why use personal allowance against a thing which is already at 0%? It will be like killing a dead person. If something is already at 0%, why to use allowance against it? Okay? So we will use the balancing personal allowance value, and that is 2,000. Okay? 7,500 against non-saving, 2,000 against saving. The remaining personal allowance is 3,070 that will be used against dividend. So my taxable income in dividend is 11,930. Let's charge tax on it. I want you all to concentrate on it. Non-saving is 0. So no tax on 0, obviously. Saving is 6,000. We capped it intentionally because 5,000 pounds goes at 0%. It's 0. And since we are a basic rate taxpayer, so 1,000 pounds go at 0%. So it's again 0. Then we have dividend income. 11930. First 2,000 pounds at 0%. So it's 0. And remaining 9,930 at 8.75%. So it's 869. So this is our tax. Okay, I'll repeat it again. I want you all to concentrate. Trading income, 7,500 goes in non-saving. Interest income goes in saving, and dividend goes in dividend. These are our columns. We add them, we arrive at the value of total income. Personal allowance, 12570. At the total taxable income level, we are a basic rate taxpayer. Okay? First, we hit the non-saving because non-saving has highest tax rates. Then we go for saving. But if some portion of saving income is already at 0% band, why waste allowance against it? You have zero non-saving, so 5,000 at 0%. You are a basic rate taxpayer, so 1,000 at 0%. Just claim balancing amount, 2,000. 8,000 is your income, 6,000 is already at 0%. So just offset 2,000 of allowance here, then move for dividend. Is it clear? Okay. One last practice question. I want you all to pause the recording and try it on your own. Okay. Try it on your own and then we'll discuss. Okay. Let's look at it. Okay. Employment income, 6,500. Interest from bank loan, 9,000. Dividend income is 13,000. Again, a routine question. First column is total. Then non-saving, saving, and dividend. Okay. Now, so let's classify the income first. A routine question. Employment income, 6,500. We will put in total and in column of non-saving. Okay. Then we have interest income, 9,000. Goes in the column of saving. Okay. And then we have dividend income, that is 13,000. Goes in the column of dividend. Is it clear? We will add up all of them to arrive at the value of total income. Okay. Let's look at it carefully. Non-saving is 6,500. Saving is 9,000 and dividend is 13,000. The column of total 6,500, 9,000 and 13,000. So it's 28,500. We'll adjust the personal allowance. 12,570 to arrive at the value of taxable income. Okay. By now, it's just a routine question. Taxable income. 28,500 minus 12,570. So it's 15,930, which means that we are a basic rate taxpayer at total. Obviously, the personal allowance is first used against non-saving. In saving income, first 5,000 gets 0% because non-saving has fallen to 0. We are a basic rate taxpayer, so 1,000 more at 0%. So 6,000 will be taxed at 0% back. So I will only use 3,000 of my allowance here and remaining against dividend income. 12570 minus 6,500 minus 3,000. So it's 3070. This gives me dividend income of 9930. Okay, so it's now just a routine working. So tax non-saving has fallen to 0. Saving, we intentionally capped it at 6,000. We don't wasted our personal allowance. First 5,000 goes at 0%. So it's 0. And the remaining 1,000, since we are basic rate taxpayer, so this also goes at 0%. Then we have dividend income, 9930. First 2,000 at 0%, so it's 0. And the remaining dividend, 7930. Basic rate band is 8.75%. So it's 694. Okay, so let me repeat it again. Just a routine question. We classified the incomes in their relevant heads, non-saving, saving, and dividend. We added them to arrive at total income. We used the personal allowance first against non-saving. Then the second priority is saving income. But since some portion of saving income was already covered at 0%, so we didn't waste our personal allowance and we moved towards dividend. Okay. So if I'll sum up my today's class, we started our discussion with qualifying loan interest expense, which is adjustable from total income, the qualifying purposes, and then we discussed planning of personal loans, non-saving, saving, and dividend. But if some of the saving income is already covered at 0%, don't waste your allowance. Okay? Directly go for dividend or go for a partial claim. I hope that you people are understanding. If you have any query, feel free to ask me on my WhatsApp. Okay? We'll continue in the next class. Thank you, everyone. See you all.